We are just over 3 weeks into 2025 and we already saw some crazy price movements from the stock market. One day, the US could be reporting good jobs data and the market goes down by 1.5%. Another day, the bank's earnings and CPI could be looking good and the market goes up by 1.8%. And with Trump coming into power this year, recession looming on the horizon, and S&P 500 being overvalued now, get ready and buckle up because 2025 will certainly be a volatile and fun year. So here's what you can expect going into 2025. But before I start, do join my 10,000 members Telegram chat group to discuss or ask any questions that you may have. Alright, here's a quick recap on what are some of the things that Trump plans to do when he comes into power. First, he plans to introduce tariffs not just on China, but on the entire world. As he puts it, we are doing tariffs on other countries. Other countries are going to finally, after 75 years, pay us back for all that we have done for the world. So Mexico and Canada, 25% tariffs. China, 60 to 100% tariffs. And the rest of the world, 10 to 20% tariffs. Basically, you get tariffs, everybody get tariffs. Tariffs are essentially taxes on imports, and the importing business would typically pass on this cost to consumers. And because of that, inflation expectations are already going up. For example, in the University of Michigan's latest survey, the 5-year inflation outlook in the US rose to 3.3% in January, while long-term treasury bond yields have also risen back to 5%, as traders are now expecting that interest rates would stay higher for longer than expected. Second, Trump plans to cut taxes on a whole bunch of things, starting with the extending of Tax Cuts and Jobs Act, which he introduced way back in 2017. Yes, that is still around and is set to expire in 2025, which is like this year. The Tax Cuts and Jobs Act was a major overhaul of the tax code that the US has seen in decades. Under this tax code, personal income tax rates were lowered, the 21% single flat corporate tax rate was introduced together with many other tax benefits that help individuals and families. On top of that, Trump is expected to introduce more new tax policies, such as removing tax on tips, ending taxes on social security benefits for older adults, as well as remove the $10,000 cap on deduction for state and local taxes. Now, while these tax cuts are good news for taxpayers, these policy changes are expected to raise the national deficit by $7.5 trillion over the next decade, after factoring in spending increases, revenue increases, and spending cuts. And that is bad. The US government debt has already been quickly adding up, with their debt to GDP ratio hitting all-time highs. And even though the US likely won't ever default on their debt, this rising debt is slowly eroding confidence in the US dollar. For example, Japan and China, the two largest foreign holders of US treasuries, have been selling away their US treasuries. If this continues, it could threaten the dominance of the dollar, as well as the economic future of the US. Next, Trump plans to deport millions of immigrants from the US, to which he caused the largest deportation program in American history. Right now, it's estimated that there are over 8.3 million unauthorized workers in the US, as compared to the 168.5 million labor force. If Trump deportation plans were enacted, the US economy could fall by 1.2 to 7.4% by the end of 2028, while US employment would be lower to between 1.1 to 6.7% by 2028. Sectors like construction, agriculture, and hospitality would get hit the hardest. This would cause food prices in the US to go up and the housing market to be disrupted. Will this happen? Maybe. He has deported 1.5 million people before in his first term, and he will likely do it again. Last but not least, Trump also plans to introduce deregulation in a number of sectors, such as energy, banking, technology, healthcare, and crypto. This will likely lead to more mergers and acquisitions, with some analysts even forecasting a 50% rise in global deal volume. This could benefit tech, investment banks, and small caps. And since tech is the biggest component of broad benchmarks, there could be a boost to the overall markets as well. Looking back to Trump's first presidency from 2017 to 2021, the S&P 500 actually did quite well. While it didn't give the highest performance as compared to some of the other presidents, it could have been higher if not for the 2020 huge pandemic crash. So will history repeat itself again? First, stocks are far more expensive now as compared to back then. Back in November 2016, the S&P 500 forward PE ratio was just 17 times as compared to 22 times now. However, some may point out that the forward PE may not be the right metric to use, as it doesn't take into account the growth of the earnings. For example, since 2016, both the company's profit margins as well as the earnings per share have increased. Because of that, this higher forward PE may well be justified. However, if we look at the change in forward 12-month earnings per share versus change in price of 2016 and now, this time there's no denying that the S&P 500 has indeed ran ahead of its valuations. However, here's where investors need to be careful. Just because the market is overvalued doesn't mean the markets will boom and crash and we will see lower returns. That's because history has shown that over the short term, the PE ratio has very little correlation to the return of the market. It's only over the long term that the PE ratio will have a bigger effect on market returns. In fact, timing the market is quite challenging and it is not necessary if you are seeking long-term returns. That's why a more effective strategy is to do dollar cost averaging. Dollar cost averaging is always helpful to reduce the impacts of market volatility by spreading investments over time, so that I can buy more shares when prices are low. It also encourages a disciplined approach to investing, which makes it easier to consistently invest without worrying about market timing. For example, did you know that if you are just consistently invested every week into Triple Q over the past 1 year, you would have gotten around 12% return? Here's how easy it is to set up RSP. First, open up the stock that you want to invest in, tap on the 3 dots on the bottom right, then tap RSP. You can ask Momo Singapore to deduct the funds straight from your bank account, and it will even perform automatic currency conversion before buying your stock. Then choose your investment amounts and investment frequency. It has been almost 4 months since I started doing periodic dollar cost averaging into Triple Q via Momo Singapore's regular savings plan, and since then, I'm up by almost 5%, which is not too bad, yeah? New users who sign up to Momo Singapore will get to earn up to $3,154 worth of welcome rewards when you fulfill the terms and conditions. Plus, enjoy zero commission for US, Hong Kong, and Singapore stock trading, as well as zero commission trades on US options every month for up to 100 contracts. Not just that, Momo Singapore is offering a guaranteed lucky angbao during the Chinese New Year period. You could win up to $888 in trading cash coupons. So check out the promotion while stocks last. Second, what's working out for Trump is that in both 2017 and now, Trump inherited a strong economy. For example, both GDP growth rates were around 2 and 3%. Both unemployment rates were around 4%. Consumer spending growths were also about the same. Heck, even the inflation rates were almost the same. So if Trump is able to effectively stimulate the economy, just like what he did back then, the better economic performance could just enhance market confidence and drive prices higher. Though, it's important to also note that the federal funds rate was much lower back during Trump's first presidency as compared to the 4.5% rate now. While the Fed is expected to lower rates this year, given that Trump policies might reignite inflation, it's also possible that the Fed might keep rates higher for longer than expected or even raise rates all over again. Right now, the latest core PCE is around 2.8%, and Bank of America thinks that the hikes will come back if the year-over-year core PCE exceeds 3% and long-term inflation expectations become unanchored. But what does this mean for the stock market? Right now, almost every analyst are bullish about 2025, with some thinking that the S&P 500 could even reach 7,000 points. If we just use the average estimates, it would be around 6,700 points, or an 11% rise from current levels. However, it's often wise to take these estimates with a huge pinch of salt, as the predictions often miss their mark, whether it's because they are too pessimistic, like in recent years, or too optimistic. And as Tom Lee suggested, even if interest rates were to remain higher for longer than expected, it wouldn't necessarily kill equities, but rather it would be a challenge for market confidence, especially if investors perceive that the Fed might be committing a policy error, either by maintaining too tight conditions or by cutting rates too aggressively. He's speaking the language of gods. But to put it simply, there were a lot more tailwinds in 2016 as compared to right now, where there's a lot more headwinds. As such, it's best to be cautiously optimistic, as there are a lot of uncertainties that lie ahead. This includes heightened global tensions, intensifying trade wars, and a possible recession. So given all this information, how should you invest now? I think, like always, The key to investing is to invest for the long term. That's because history has shown that the market tends to go up no matter which president is in office. Rather than political leadership, corporate earnings and economic fundamentals matter a lot more. Peter Lynch has once said that far more money has been lost by investors preparing for corrections or trying to anticipate corrections than lost in corrections themselves. Sure, you can say that the market is way overvalued now, and you might just want to wait for a crash. But just how many had that thinking and missed out the incredible 20+% gains in 2023 and 2024? For most investors who invest over the long term, these gains or losses that you see in your brokerage doesn't mean anything, as you aren't planning to sell now. It is like our homes. Even if they have gone up in prices, it doesn't affect us in any way. So why should our long-term investments be any different? Therefore, it's always important to remember that when we are investing in a company, we are investing in their earnings growth, as shown by this huge blue section here. So markets up, you buy. Markets down, you cry a bit, then you buy more. And with Trump in office, the next 4 years will be pretty interesting.